I'm excited today to introduce Jolon Knight from Hyperion Asset Management and the continuation of getting to know what we own and why we own it. So, Jolon Knight, thank you so much for your time.
Thanks, Rob. Thanks for having me on.
No worries. Now, before we do get started, I need to touch on the general advice disclaimer. Any information that Jolon and I discuss today is general nature only. Anyone acting on that information does so entirely at their own risk. And if you would like to learn more, please come and see me and we can talk through it a little. So, Jolon, let's get started. I mean, Hyperion has been around for a while, probably started in the early 2000s and then evolved from a domestic product into a global product. So today we're going to talk more about the global fund. And I want to understand a little bit more around the investment philosophy and who Hyperion is.
Yeah, thanks. So you're right. Like we've been investing in growth as a style equities actually since 1996. We started our broking firm, called Wilson HTM with our private portfolio management. We split out from them in the early 2000s. You're right. We unitized our two domestic products, our small companies fund and the Australian growth fund in 2002. We've always looked at global equities since 96, and then we launched our global product in 2014. And so that's got an over 10-year track record in it. And all three products are identical, how we invest and why we invest, which is where we allocate capital. And what we're really trying to do as a growth investor is, in Hyperion's view, try to invest in the elite businesses of the world. And these are new world businesses. So what we're really looking for are innovative companies that are doing something disruptive, have new technologies, have what we call sustainable competitive advantages, structural tailwinds. We really like owner-operated or founder-led businesses because they think really long-term. Big fan of debt. Almost all of our companies have net cash on their balance sheet, and they truly have large addressable markets. So they're not just selling into one geographical location or a single product company. And kind of better idea of understanding what we're looking for is kind of what we're avoiding. So we're avoiding what we call old world businesses that have low or no growth. They're very sensitive to economic conditions around them. They have a product offering that is likely to be disrupted and low levels of predictability in their earnings. So think about the things that make up the majority of the exchanges around the world, like your traditional banks and services business, your commodities and commoditized products, or fads and early stage startups. All of those type of companies, generally old world, and they're very reliant on economic growth around them to do well. Conversely, if we can find a subset of businesses that are growing by taking market share from those old world companies for a product or service that's innovative, it's new age, and has a very long and predictable earnings profile in front of it, we'll go to work and we'll try to identify if that's got something special that we can own.
Yeah, understand. Interestingly, too, from this little slide on the presentation at the moment, you can see there that the alpha that you've generated from being active managers and selecting these quality companies has delivered a lot of the returns. Can you talk a little bit about that?
Yeah, so alpha is returns above benchmarks, so us outperforming. And so you can see on that chart there or the graph there that only 10% of the money that we have of that 17 to 18 billion as it is today has come from money from investors. 50% or half of it has come from just normal market returns, and 40% has come from outperformance. And that's a really strong track record that we're happy to stand behind. And that effectively means that just under half of the money that we've been able to produce for our investors has been outperformance. So over that 20-odd year history.
And if we talk about that longer term history since inception, again, another table here that highlights the successful style and skills of the analyst and the team. Here, since inception, you've delivered 5.9% performance per annum against the MSCI World Index. But more specifically, and there was a real period of volatility that we both lived through, which if you look back at the 3-year performance, I mean, I'm going to say only delivered 1.5% return over that period, excess of the market. Can you talk a little bit about the lessons you learned from that period of 21 and 22 when bond yields and interest rates started rising aggressively?
Yeah, it's a really unique time, and 3 years is a good one to look at, but let's step back and look at 5 years because that's taking in 2019 to where we are today. And that is really encapsulating that crazy COVID period. And then as we rolled out, had inflation, had bond yields rise rapidly. They've never risen that rapidly over 250 years. It really was an anomaly. And then a normalization, which we've experienced in 23, 24, and now rolling into 25. And so, if you think back to 2020 when this all started, markets really rallied exceptionally fast with all the stimulus that was thrown in, which clearly, wasn't needed as the world continued to work just fine. And 21 was kind of a flat year, and 22, the crazy Russian and so on, there was a lot of inflation that started, creeping into markets, and bond yields, rose rapidly, especially the 10-year bond yields. For layman's out there, generally when bond yields go up, asset prices come down. It's effectively a duration effect, time value of money, if any of you guys remember that from university. So there wasn't a lot anyone could have really done about that. It was just an extremely rapid rise of interest rates in an extremely short period of time. The view with Hyperion was that it was transitory. We didn't actually change our investment process through that time. We were actually buying the majority of that time through 22 because the companies were still posting really, really strong underlying fundamental results. Their earnings were growing 30 or 40% per annum throughout that period. And so, yes, there was a lot of pain that was felt during 22. But the flip side of that was, the recovery in 23. I think we did about minus 30, minus 40 in 22, but then we did plus 70% almost in 23. And last year, 24, we did, I think it was about nearly 52% or whatever it is. And so here at Hyperion, everything we do is with a long-term mindset. And so we had the view that 22 was an anomaly. To support that view was the underlying economics of the businesses actually outperforming, doing exceptionally well ahead of our expectations. And then throughout, as we found over the last few years, has been that recovery. But interestingly enough, if you have a look at our 5-year returns over that really difficult time period to where we are today, you can see we've done 21% per annum, which is just a little bit ahead of our 10-year numbers and our inception numbers. So if you were to only look at our performance, every now and again throughout that time period, or even now with that longer term view over 5 years, you can see that it's actually a normal return profile, even with the volatility that we've had. So we're really happy to be able to outperform, through that period of time.
Great. And given the fund itself invests in quality businesses, let's talk a little bit about those investments that you have and whether you think you can actually continue with that growth of 20-odd%. If we focus on the portfolio of companies at the moment, how many companies do you own in the portfolio, and what are you actually looking for, and how do you look at the weightings of each company that you put in the portfolio?
Yeah, so there's 22, 23 companies in the portfolio. That's kind of our sweet spot. We'll say the PDS, we'll say 15 to 30, but the sweet spot's around 20 to 25. And again, what we're trying to find are those elite businesses of the world, and how we actually allocate capital is what we call a power law. So returns don't come in a nice orderly bell curve as you taught in school. The way to think about it is your 80-20 rule. It's actually a little bit stronger than that throughout time in stock markets. It's about 95-5. So 95% of the returns, really come from about 5% of 5% of all companies. And so we want to allocate capital in our portfolio in that same type of thing. So pushing capital to where we see the highest risk-adjusted returns within our portfolio. Now, we have a standardized approach into valuing companies and also a standardized approach into moving weights around as well. And you just can't walk in one day, figure in the air and go, oh, geez, I was listening to Spotify this morning. How good is that? Top weight. It's like, what's changed? Okay, where's their long-term valuation? What's our business quality score change? What are our risk adjustments looking like? What's the rest of the industry doing? So it's very collaborative. There's no silver bullet. There's a lot of things that add up to push weights up and down. But then once you actually set weights within the portfolio, you need a structured approach to deal with non-fundamental share price moves. Because your day-to-day share price moves, it really is just a random walk. So if a share price for us, runs one day and we've got 100 basis points, 1% buffer around our target weight, then it breaks through that. All things being equal, there's no change to our long-term valuations or our risk adjustments. We'll probably be selling into that strength. And conversely, if it's coming down, we'll probably be buying into that. Yes, we call that top and tailing. It's worth about 20 to 30% of our alpha over a long time period. A lot of people say, you buy low, you sell high. Well, we have the data actually to prove that we do that. And then, this is a really good slide that you've got up here as well. It said we own 23 businesses in the portfolio.
So, John, to go back to your point, why is 22 or 23 the sweet spot?
We've found over doing this for 25 years that, generally our returns, you can look at our top 10 and a lot of the returns come from there. And that's just from allocating capital, as I said, to those higher risk adjusted returns. And so all the literature and the research that we've done, you can effectively have a diversified portfolio or thereabouts with 10 to 12 names. But then you also want to have scope for companies coming into the portfolio, some that, on a relative basis don't look as attractive as some of your highways. And then also a tail for businesses that might have some cyclicality or going through some troubles as well. So you can expand that and have a portfolio of 20 to 25 names to really give you scope to be able to improve the portfolio over time or pull some things back that may not demand capital as much as the ones at the top.
Okay, thank you. And so looking at this chart again and talking about the portfolio at the moment, current largest or highest conviction company you've got in the portfolio?
Yeah, so the top weights at the moment, Tesla's, they're at the top. ServiceNow is up there. Amazon, Microsoft. I'm just looking at it now. I'm probably rounding up the top 5. Would even be something like a Spotify or something like that. It's really high quality.
And Tesla, you either love it or you hate it. And obviously there's been a lot of debate around where Tesla's headed. And every time we do catch up, I love hearing your views on Tesla. So can you share with the audience your views on Tesla? Why got such high conviction?
Yeah, it's a really interesting business, and we think it's probably one of the most misunderstood companies in the world still. So they've got absolute leadership in EVs. Their technologies are some of the best in the world. Their batteries are some of the best in the world. They can produce cars better and more efficiently and more profitably than anybody in the world as well. But aside from that, and there is a lot of competition coming from China, and we don't deny that. You just have to walk around here in Brisbane, and I'm sure it's the same down south where you are. But there's BYD everywhere, absolutely everywhere, and they're at a different cost base as well. So they're that entry level side. What BYD doesn't have is the ability to update their vehicles over the air, their software, their fast charging, and their self-driving technologies as well. And so that's the really interesting part that's coming this year is the full self-driving for Tesla. Our team's been over to the States a few times. They've hired the latest model cars with the latest software, and it's driven them around Southern California without them actually touching the wheel. So we know firsthand that this self-driving software does work. And we saw at that event last year in California when Musk came out with the robots and the self-driving vehicles, that they've said they're going to start releasing them into the friendly states in the US, which is Texas, Arizona, in California, the self-driving vehicles, and they'll be able to monetize that quite well as we step through this year. They're also releasing cheaper model vehicles in the first half of this year as well, which is really exciting because they're the vehicles that will then start competing with the Chinese vehicles. And those vehicles will also have the ability for the self-driving technologies. So right now, if you want to use self-driving, you can spend $100 a month on a subscription, or you can buy it up front for $8,000. And then what Tesla's also doing with their robo-taxis and these vehicles, they have their own app. It's like Uber, but it's just for Teslas, for Tesla owners. And so you'll be able to ride share on a Tesla car through the Tesla app, exactly like you do with an Uber. And Musk said, and take it with a grain of salt, that he can get the cars on the road for about 40 cents a mile. So taxis at the moment in the US, even here in Australia, is about $3 a mile. So be completely devil's advocate and call it $1 or $1.50, just to be really conservative. If they can beat half the price of a taxi, then there's actually a reason why you will actually get a car that doesn't have a driver. And we know there is a market for driverless vehicles. Waymo in the States, in America, is already doing driverless vehicles at the moment. They're doing about 200,000 trips a week, and they have price parity with taxis. So it's a gimmick. You're actually saying, I want to get in a Waymo. I want to get in a car without a driver and pay the same price as a taxi. We don't see Waymo competing at the moment with Tesla because their vehicles cost over $100,000 just to get on the road, and that's being conservative. Whereas these Tesla robocabs, all the cheaper models that are coming, they've been slated to cost around $25,000 on roads. So there's economics to scale there. But outside of that, Tesla has their energy business, which is growing at an extremely rapid rate. You might think of that as your power walls, those big battery stations like they have in South Australia. Pretty much every green energy player in the world will need some type of big battery plant, whether it's Tesla or others. So there's massive amounts of growth there. They have their supercharging network, which is growing at a rapid rate. In the US, they also have an insurance arm, which is slowly starting to creep out outside of the US. So if you have a Tesla vehicle, you're going to get Tesla insurance. They know how you drive. So you might get a higher or lower premium depending on how you drive. And much further down the line, there's also the Optimus robot, which is equally as exciting. I mean, we're seeing a lot of news flow on other type of humanoid robots, specifically coming out of China and others as well, which is a really big development. So yeah, it's not just a car company. The cars are highly profitable and it's funding the rest of their ventures. But yeah, we definitely expect to see, Tesla grow over the next decade and beyond.
And this is a perfect example, Jolon, as to why you do what you do and can identify mispriced opportunities. Is that fair to say?
Yeah, absolutely. And this is a really good chart that you've got on the screen and speaks to that top and tailing that I was speaking of. And so the blue line there is the share price over time of Tesla, and the pink shaded area is the number of shares that we've owned over time. And so you can see, very rudimentarily that, as the share price goes up, the number of shares comes down. And that's really highlighted in that December 22 period when I call that peak Elon, when he bought Twitter and everybody thought it was all over and the share price effectively went from, more than half, went from $300 down to $100. And you can see the number of shares that we own doubled during that period. And, not too long after a 6-month period, it appreciated, massively, 150, 200% again from there. And so, we trimmed that position as it started to rise. Nothing wrong with the company. It's just the amount of shares that we held relative to the weight and, came down. We've done exceptionally well in that position over time doing that.
Now, we are recording on the 28th of January, and we've just, the headlines have hit around DeepSeek, a Chinese threat to AI around the world and US dominance. It's much more cost efficient. It doesn't require the expensive chips like where we thought we may have. So let's talk a little bit about your views on artificial intelligence and machine learning and how you look at it and whether you believe there are threats and how is the portfolio positioned for those threats.
Yeah, well, we might just talk through this slide and then we'll allude back to DeepSeek because it's a really interesting topic point. And bearing in mind, it's Australia Day long weekend. I love speaking to my analysts quite a long weekend and figuring out what's going on. But yeah, AI machine learning is massive. Like, it is the next leap forward. So if you think back, the big leap forwards in technology we've had over the last 20 years, the internet in the early 2000s, smartphones and devices, 2007, 2008, 2009. Then there was a big bit of cloud computing in the mid-teens that everybody kind of missed. And now it's AI and machine learning as we make our way through the 2020s. And it's really just moving things a lot forward. And we think it'll really develop in around 4 stages. The first part now, and the 2 parts are the obvious ones. So selling products to the hyperscalers, and the hyperscalers are your cloud computing guys. And that's ASML that makes a lithography machine that, prints a pattern on silicon wafers that become computer chips. They're effective monopolies. No one else can do it. NVIDIA sits in that spot as well. The second part is the cloud computing guys. There's more inference and AI type of computations happen in the cloud. They'll really benefit from those computes. You don't have to go looking for that. Amazon, Microsoft, and Alphabet, they're the 3 big guys. There's light years between each of them, and there's light years between the person in 4th position as well. And then it gets interesting when you get the recurring revenue models coming from the software guys. So Palantir, Microsoft with their Copilot, which you probably use, ServiceNow, Salesforce, that have some more application type software that comes. And then where it gets fun is the real use cases when we get those processes in our hand and they move from the cloud to the edge. So our devices, whether it's Tesla with self-driving, Block with their point of sale terminals, teaching you how to run your business better, Meta, the metaverse, and Lima 3 on the messaging things. And again, ASML providing the chips for all of those. So you don't have to actually go hunting for the companies that are going to do well out of this. The incumbents are uniquely placed to be able to leap forward and take advantage of the data that they already have. And so we're really excited. It really is a big paradigm shift with AI and machine learning, what's going to happen with these companies over the next 10 years, as it did, the 10 years prior. But then to think about what's happened over the weekend with DeepSeek is really interesting. And again, it's still very fresh. So we'll timestamp this, put a big disclaimer on. But effectively, what's happened is the Chinese have come out with their R1 model, their DeepSeek model, and said, we can do what the US are doing at a much more efficient rate. That's effectively what they've said. And if you take a step back and think what's happened in China, so there's a lot of really, really intelligent people there. They're Some of them go and work in Silicon Valley, and some of them stay in China. What's happened in China is they've actually been hamstrung, where the Western countries in the US haven't actually given them the computing power through processors as what the US have had. And so these really smart people have had to think, how can we get the same type of inference results that the US is getting with our limited power? So they've effectively run a lot of efficiencies and worked back with the problem backwards and created a process of being able to get, as it looks like at the moment, the same type of compute power from their lower powered chips versus the higher powered computer chips over in the US. Now, this is where it gets really interesting. The Chinese are using open source, software to create this. And so if they're doing well with these low processor chips and run efficiencies, to give you an understanding, like, OpenAI costs them about $3,500 to do an inference process on those high powered chips. The Chinese can do that at a fraction of the cost with a low powered process. If you can take how they've done that and re-engineer it over here in the US with these high powered processes, you are going to get much better, much cheaper inference results in the US with the high powered chips. And so AI, machine learning, training models, language models and the like, you're no longer just going to go step by step, greater in compute and results. You're effectively, starting to really run up the curve. And so we actually think and it's early, this could be a big leap forward, which is what NVIDIA and Jensen have effectively been saying, that it will take time, but sooner or later, you're going to get the cost per compute down. And they've done that in China, it looks like. But if you can take that technology and put it on a high power processors, it looks really exciting of where we can actually take this. And so, yes, NVIDIA is down like 15, 20% or whatever it is. It doesn't make a lot of sense at this stage, because you could actually take that know-how and put it into the better processes and then see what those results actually, get to over time. So it's a really interesting time. We actually would be an exponential growth curve and another leap forward in AI and machine learning processing, because it makes efficiencies run a lot better. Or this all could just be Chinese propaganda, and it's, but we'll wait and see. It's been one day.
Yeah, it has been one day. You're right. There's still so much to learn, but to understand this process, one thing that you highlighted was the cost coming down, and that for me also highlights potentially the adoption. Then for them,
Absolutely,
yeah,
it's
thrive as well.
If you can democratize AI, you can unlock huge amounts of innovation. Now, and you need to be able to compress and improve the models over time, which is what it looks like the Chinese have been able to do. So if you can do the processing that they were doing on the high powered, on the low powered ones, just imagine what you can extrapolate that through to the high power processors now. Like it's a pretty exciting period of time. And we're going to have big leaps and bounds in AI and machine learning. These models are training themselves. They'll be able to find efficiencies. So we're probably the wrong side of 40 to be able to truly appreciate just how exciting this will be as we launch forward. But it's a really exciting time. And we can already see the monetizing stages, as you can see here on the screen. So really, we're really happy with how our machine learning is starting to evolve.
And then finally, just to kind of bring it all together, let's talk a little bit about the headlines around extreme valuations and bubbles and all of these things. How can you give investors comfort that, hey, yes, maybe valuations are a little bit stretched, but we think we've identified the companies that are going to continue to deliver good growth?
Yeah, well, that's something that we always hear all the time here at Hyperion, that valuations are stretched. I heard that back in the early 2000s. I heard it in the teens. We heard it in 2019, 2020, 2020, fair enough. But even last year and the year before, valuations were stretched, and yet time and time again, we continue to be able to outperform. And what we can fall back on is this chart that you've got here, that historically, our global portfolio has had earnings per share growth of around 22% per annum. And forecasting out over the next 10 years, we're running at around 23% per annum. Our benchmark in MSCI World, EPS growth is sat at around anywhere from 7 to 9% per annum. And so if we can identify these businesses that have, 2-3 times more earnings per share growth than the benchmark, than their peers, then they'll be able to outperform over time. They should be able to outperform over time. we're often told that valuations have never looked this stretch or the concentration's never been this great. It's always like this. You think back 10 years, you think 5 years ago it was the FANG. Now it's, I don't know, there's even more now. 10 years before that, it was Apple, it was AT&T or whatever it was, Microsoft. 10 years before that, it was the oil and gas companies. 10 years before that, it was the logistics and freight companies and so on. So it's, again, that power law, that 95-5 rule, it is always a small group of companies that are responsible for returns. And if you're able to identify them, if you have a process to be able to weight them correctly, push capital around in a risk-adjusted way, and these businesses perform, again, the earnings per share growth, there's no reason why you shouldn't be able to outperform over long periods of time. And that's something that Hyperion's been able to do successfully and have a pedigree of doing for over 20 years.
Yeah, I suppose this is also the benefit of active versus passive, identifying the opportunities, the new world companies, and then shifting as the I suppose the drivers or the beneficiaries of where we are in the market continue to change, and that's what Hyperion has done for a long time. So, Jolon, for conclusion, if anyone wants to learn a little bit more about Hyperion Asset Management, where do they go, other than myself, of course?
Yeah. You first, Rob. Jump on our website, hyperion.com.au. There's a wealth of knowledge there. There's webinars, there's insights. There's also every company that we own. We're very transparent. If you go to the Insights tab, drop down, there's company profiles, both domestic and global. And we'll tell you why we like them. It's all there. So, yeah.
I must give you credit. You are very transparent and very appreciative of that. So, Jolon Knight, thank you so much for your time and have a great day.
Thanks a lot, guys. Cheers.